taking an unconventional look at stocks, property, bonds, economics, and more. This is the Total Money Management Podcast with Steve Moriarty, Tom Hill, and Jacob Senior.
Hey everyone, welcome back to Total Money Management. Today we're going to be talking about the week that was from the 26th of Feb to March 1st. And there's a lot to get through, but as always, I'm with Tom Hill and Steve Moriarty. We good?
We are fantastic.
Magnificent.
Excellent today.
Last week we didn't mention the Magnificent Seven. We talked a bit about it in a video, that's about it.
We're growing.
That's good, yeah. We're getting
What are we doing?
We're learning.
We've got a heightened EQ. No, but we did talk about China and property.
I feel better already.
There's obviously a lot to get through today, and last week was really fun. Actually, I like talking about everything that we did last week, but we missed the chart of the week. So I want to spend a couple of minutes just explaining what that was. And for those listeners out there, I think we had a few at Norway and Sweden last week, or the week before.
Oh, Scandies.
So we're getting out there now.
We're a global podcast. global reach.
But for those that have no idea these buzzwords that we keep going on about, like the chart of the week, it's for the subscribers. And if you're interested, head to the website and send us a message, and we can chat to you about it.
And subscribe.
Yeah, obviously, just subscribe. Give us your money.
Yeah.
But an interesting one that we're looking at here, and we talk about it a lot, is risk and return. So, at the moment, you'll get about 4% in US bonds, with what we like to. Well, not just us, but it's basically seen as 100% risk-free and it's safe. So you put your money in, you get your money out when you're finished. So to invest elsewhere, you kind of want a higher potential. The point is, if you're going to invest elsewhere, you want to be able to project a higher potential return, which compensates for the risk of losing that money. So in the charts we're looking at below here, you can see the dividend yield on the S&P is a lovely 1.47%.
Woohoo!
Which is obviously well below the bond yield and well below inflation. And people just people just keep ignoring that, which is stressing us out a bit.
Yeah, that's why we talk about this really boring subject of valuation, right? Because and again, it's this psychology of getting, who cares if you get 1.5%? The S&P's at 5,100. It's making all-time highs. Man, it's kicking it. And it's saying that's fine, but do you know where you are in the scheme of things?
Yeah.
Right.
And I think it's actually worth highlighting. I feel like we have to kind of bring this up just to kind of underscore this. It doesn't mean that we don't touch the US.
Absolutely.
It means that with the long-term strategies, we got bugger all in the US. But with the short-term stuff, the volatility's been a lot of fun.
Yes,
right?
it is buying a company that is really cheap that you say, listen, I know the market's expensive. Listen, I know that this stock will probably fall further, but I would buy more.
Yeah, it's cheap now. If it gets cheaper, awesome.
Yes, exactly. Yeah. That's all old Uncle Warren does. Mm-hmm. Buys the company and says, if it gets cheaper, I'll buy more.
Sorry, did we derail you?
No, I mean, everything you guys do derails me, but no, not at all. I was just going to talk about the same thing, other than I was just going to add that the PE's obviously nuts 30, what's it at, like 34 and a bit?
The Cape.
Well,
yeah.
The Cape, yeah.
Yeah, but the PE, even the normal, quote, PE, is like 27.
Yeah.
Like the normal PE average is about 15.
Yeah, but if we compare that to NVIDIA, that's cheap.
Okay, thanks for coming, Tom.
That's an interesting point, actually, because people do that, right? I was having a conversation with a bloke last week, and he was going, well, the PE of Facebook or whatever is 90,000, whatever it's at.
Yep.
And we're saying, well, the average PE is 15, and comparing cross-sector PEs is a recipe for disaster anyway. Because if you're going, well, the S&P is at 27, but Facebook's at 98.
Yes.
So we've still got room to move.
So they're thinking, we've still got room. And we're saying, no, it's not. You can't do that.
Yes.
Like, that's against the rules of investing. Almost.
Yeah, that's just saying that Facebook's just absolutely nuts. It's not saying that.
It says the average PE is 15. If we use 90, okay, so that means it's 6 times the average PE. That means that Facebook is going to grow 6 times over the average. So if the average growth is 3%, Facebook's going to grow at 18.
Yeah.
Right? Ding, 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 ding. It just keeps going. Clearly, that is wrong.
Well,
Now,
it's not
there
sustainable.
is an argument that it might be good for the next 5 years. That's how you get growth companies. But the next 30? I don't think so. And again, like we said in the last episode, the proof is we go back and look at history and go, every company who's had a PE over 100 has always reverted. And it has to revert because otherwise Facebook ends up owning the world, right? You can't just keep extrapolating out. And we talked about that with Tesla, right? Tesla guys going, oh, Tesla's worth $4 trillion. It's like, oh, you morons, right? Because that means they're going to sell every car. Well, they're clearly not going to sell every car in the world, right? But that's where the inexperienced investors go, yeah, Tesla's worth it. Oh, that's a great argument. And it's like, hang on, dude. Just go through the numbers there. That means Tesla's going to sell every car in every country in the world. That's when you go, oh, okay, yeah, well, hang on, I need to have a look at that. And narrow it down. It's going to sell every car in America. Oh, no, probably not. Okay, well, it might sell every car in Virginia. Well, no, probably not either. That's when you start to go, well, hang on, it's really badly overpriced. Now, it doesn't mean you can't make money out of it, but you don't want to be a 20-year buy and hold investor when the PE's at like 90. Crazy.
It's nuts.
That's a good point.
All right, let's fast forward to this
The
week.
big issue, it appears Australia, like many other countries, is heading towards a recession.
Well,
Who
that's
would have thought?
That's a dirty word.
Yeah.
Isn't it?
Well, I mean, I've been hearing that for a couple of years now. Jim Chalmers put an article out, and just to underline a few things, wages aren't growing as strongly as they were. Inflation is slowly but certainly a long way from the RBA's target. And the concern is that we might find low inflation, but at the cost of economic growth.
So, in other words, we're doing what Japan did.
Well, yeah, essentially. I mean, we're growing at 1.2% or something. I mean, let's be honest, that's not exactly knocking it out of the ballpark, is it?
I mean, the only thing I see out of this is, Chalmers is obviously the treasurer, and he's going, well, I'd like to stick around for a little bit longer. So how do
I do it?
How do I extrapolate that out?
Politics is about getting people's mindset into your agenda. And so what Chalmers is trying to do is sort of say, look, if a recession comes, don't be surprised, right? Because the first thing that happens in a recession is people blame the government.
Yeah.
Right. So Chalmers is looking at that. He's got more data than anybody. He'd be looking at that going, okay, we've planned to spend X. That's not going to boost. That's why I said a few weeks ago, wait and see what happens with the tax cuts and to see whether people spend them or save them, i.e. pay down the mortgage debt or whatever debt they've got. As soon as you do that, you're not spending it in the economy, which means you're not going to generate economic growth. Okay, and that's why I think this week, which is, what are we in, March or whatever, just early, late Feb, what Chalmers is saying is, an elbow is we might have some goodies in the budget as well, right? Because they know, they're looking at it going, the spending is not coming through because you've got two sources of new money, which is government deficit spending or bank loans. Now, bank loans are taken out by people to build a business. Well, I'm not building a business. Why not? Well, economic growth's at 1.2%. So I don't want your money. So all of the spending, most of the borrowing has been gone to speculating in property, which creates some growth. But as I've said before, that growth has got to come from the income. Tom, you just said income.
They're
right?
not really growing.
It's not really growing. So, and generally it's been falling. So you have to say, well, hang on. I think it was last week, Jacob, I was saying to you, the example of, you got $1,000. Well, borrow 500 and buy a property. Oh, you've still got 800 left. Well, borrow and buy another property, right? At some point you get to say, I can't borrow anymore. Right, because the last $500 I need to live.
Well, the banks will say, well, sorry, we're not going to lend you anymore.
Well, that's the alternative, yeah. Exactly.
Which is happening more and more now, right? Which we're starting to hear about.
Yeah, the delinquencies are rising.
Yeah. I mean, the other problem is, the renters are complaining about the rents going up and the homeowners are complaining about the mortgage rates. So
Happy days all around, everybody.
we'll just have to see where it goes.
Well, I know for a fact, I was at a seminar, I think I've talked about it a couple of times, where Chalmers was speaking. And I know for a fact he has the big four bank CEOs on speed dial and speaks to them daily.
Absolutely.
So they're trying to obviously navigate it for the quote unquote best interests of the Australian population. But
best of luck.
Yeah, there's only a couple of doors that we're going to go down, and one of them is absolutely catastrophic decline, like the US method we talked about it, or we spend the next 20 years
going nowhere,
grinding it out and going nowhere.
That's the only two possible outcomes, right? That's why it sounds arrogant, but I'm telling you, that's the only two possible outcomes when you have a mountain of debt. You either collapse and pay it down quickly, or go, bankrupt, or, which was the American way in the GFC, or you do the Japanese way, which is the government says, right, I will just continue pouring money in, and you guys can continue working and paying down those horrendous loans on those properties that you bought for $1.5 million. Well, that's the only two outcomes. Or you can say we're going to absolutely go gangbusters for economic growth. But what that means is the government's got to spend an absolute bucket load of money because you guys are not borrowing anymore.
Yeah. Well, my issue with that, and I'm going to derail you two now, is the debt in the US is 34.4, I think, trillion.
Yeah.
So if we use the US method and say, let's just capitulate and we'll absolutely destroy the economy and everything for the next couple of years, how do they still have $34 trillion worth of debt?
Because the government, this is the difference between government debt and private debt, right? If we live in a world, we live in a country called Jacob Land, and Jacob. And Jacob
lives now.
The reason why is because in Jacob Land, Jacob makes all the money, and they're called Jacob dollars, right? So it's stupid if I go, oh, Jacob's going to run out of money. It's like, dude, he makes the money. It's the same with the US. People go, oh, the US is spending so much money, they're going to run out of money. You idiots, they actually make the US dollars. Right? They make them out of nothing. That's where it came from.
It's the money trees.
You can't. You can't run out of money, right? Because you're a sovereign government. So if the US said tomorrow, right, righto, we're not going to borrow any more money, and we're not going to spend any more money, the US would collapse because there's no new money coming in, right? But what they're doing is saying, oh, Steve Moriarty, who uses Jacob dollars, is the same as Jacob, who makes the money. Well, clearly not, because I can't make the money. Jacob can, right? So the US government makes the money. Tom Hill, who lives in Virginia, he doesn't make the money. So if Tom borrows, he's got to pay it back from his income. The US government says, no, well, just make some more.
Yeah.
Now, inflation's a problem, right? But that's for another time. But simply saying it cannot go bankrupt. Australian government cannot go bankrupt. And you hear this bullshit all the time about, the government's got to be careful about their budget deficits, nobody will buy their bonds. Oh, Jesus. I mean, economists, honestly.
We got bigger problems if that happens. The whole world will just...
Yeah, absolutely. Absolutely. But what I'm saying there is the budget for a government is not a constraint. If you look at Japan, 30 years ago when the markets collapsed, right, the stock market and the property market, Japan has had a budget deficit, right, the deficit to GDP is like 250%. They've been saying for 15 years, Japanese government, it's all over for Japan. It's like, oh, okay. They just keep printing more money. Oh, it's all over for Japan. Or they say, it's going to create raging inflation. Okay, well, Japan's inflation is about 1% for the last 30 years. So if you don't understand how it works properly, and this is the important part, your investments will be wrong because you're working on the wrong thesis. You see, and that's what we talk about with the efficient market stuff, right? If you believe in it, well, you're going to be wrong because the theory is not the way the world actually works. And now, you remember last year, everyone was saying the US was going to be in recession, right? It's heading for a recession. Why? Oh, well, government spending, interest rates are going to go to the moon and, it's going to be all over. Here we are. What's US GDP growth? About 6%. They're knocking it out of the ballpark. Why? Because Biden's spending a bucket load of money, right? But you see, that's what I mean. The economists who use the classical theory go, oh, this is going to be big trouble. It's like, really? Everybody's employed, wages are rising, inflation's falling, the government's spending an absolute bucket load of money and investment's booming. I'm sorry, where's the problem?
Kick the can down the road until next year.
No. You see, because that's what they do that saying, they kick the can down the road. And what I'm saying is, no, that's only if you have a misunderstanding of the way the economy works, right? You think, they're putting the bad time on. Yes, that's what they're doing. They're waiting until it gets to 280% of GDP like Japan. Yes, they're definitely kicking the can down the road, right? But the other thing is too, what the government does eventually is says, we're going to start reducing our spending. Why? Because the economy's overheating and we're getting inflation, right? So what people do now is go, the government's going to spend 8% of GDP in a deficit for the next 30 years. And it's like, well, clearly they're not going to do that, right? Because they might do it for another 10. And they'll do it, why? Because as we talked about with military spending and social security, but they sure as hell aren't going to run out of money. You think, Jacob, they've been saying, the next generation, you blokes, right? I'm a boomer. So I say, you blokes say, Jesus, Steve, you're leaving it all for us to pay back. Really? Why? My father didn't leave me. And, I got a better life than my father had. And my father had a better life than my grandfather. You guys are going to have a better life than I am. Oh, yeah, but we'll have this big debt. No, you won't. They've been saying that bullshit for years, right? It's the next generation's going to pay. All right, here you go, Jacob. Here's your $2 million house, your $200,000 a year wage, and, there's some debt there that you'll hand over. It's a circle, right? No one ever says, in voting terms, no one ever says, geez, I tell you what, I'm worried about the budget deficit.
Yeah, I love this, the narrative that the boomers are ruining everyone else's lives and they're all so selfish. And I think I was talking to a guy on socials. I said, well, what would you do? What would you have done? If you had an opportunity to buy interest, let's just exclude the fact that interest rates were at 16 or 18%. If you had the opportunity to buy cheap and sell high, what would you do? No, sorry, no. I won't do that.
It's morally
because my
incorrect.
Grandkids will have more debt to pay back. No, you do exactly the same thing and you create a better life for your kids. So if we have the opportunity to make a bucket load of money in investments and have 25 properties by the end of our life and we hand them down to our kids, amazing.
Absolutely.
Why wouldn't you do that? This is the argument I was having with someone saying that boomers are the worst thing to ever walk the face of planet Earth. I'm like, well, no, they just took advantage. Not everyone, but people took advantage of the opportunity in front of them.
It was also too what we were talking about with the last one. We were talking about mindset, right? What people are doing is attributing whatever's going on to the individual. And what I'm saying is it's not the individual. It's what the circumstances are when you reach that age. So the reason why I said, the reason a lot of property gurus are about 45 to 55 is because in 2000, Australia, America, England, all of those countries were flooded with capital after the Asian financial crisis, right? That's when I started buying property, right? It wasn't because I was a boomer. It was because there was a flood of money, interest rates were falling. That's got nothing to do with me. That's got nothing to do with my mindset. I didn't wake up in the morning and go, I'm going to get interest rates to fall, right? I just got up and the bank went, mate, do you want some money? I went, yeah, great, I'm going to buy a unit and they're going to buy a house and blah, blah, blah. And but it's really important because what you're saying, Jacob, is, that people are spotting the boomers when it was like, no, we were 20, right, in 1985 when the stock market was the Cape ratio of 7.
Luck. Skill versus luck. We talk about it a lot.
But
Exactly.
they also
Exactly.
also had to roll the dice to benefit from that.
Yeah.
Oh, yeah, but Tom, this is the thing, when banks are giving money to anybody, right, I mean, you can get a bank loan now, in about bloody 5 hours. I mean, do you know what I mean? The banks are just throwing money everywhere. Well, if you throw money everywhere, mate, people are going to borrow to speculate, right? And that's what's going on.
Well, right now we're in a position, right? Now that we've spoken about this before, now the asset prices are higher and the interest rates have moved up a bit, it's just hard to borrow enough.
Yeah, it's hard to get
to play
into
that
the
same game.
Absolutely.
Now.
But you think now, you think about your case. If your mother and father died, you'd get left a decent wad of money, right? Or your granddad or something. So what I'm saying is, sorry,
Let's not think about that.
No, I'm not being morbid. But what I'm saying is, the people complaining about boomers are complaining about their mother and father. That's what they're complaining about. Right, if you're 30, if your dad is, say, my age, right, 61, 62, 63, right, I'm a tail boomer. So if my son grew up and said, fuck, my bloody dad was a boomer, that the bastard I had to play, and I say, here's $3 million, he go, oh, Dad's great,
Yeah.
right? But that's why I think it's no good saying, oh, the boomers have done, the boomers have ruined it. Oh, Jesus, please.
nothing to do with the boomers.
We gave you, we boomers also opened up the economy and gave you cheap iPhones and cheap cars and blah, 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 blah. And you go, oh, air conditioning, swimming pools, blah, blah. You don't go, yeah, that sucks, that stuff, right? Because when I was your age, there was, air conditioning was basically for rich people, right? The only swimming pool you went to was the local bloody public pool. So there's all these amenities. Cars used to, break down all the time, right? It was terrible. But at the time, it was just like, oh, well, that's the way it is. And, you didn't say to yourself, oh, Christ, I wish someone had invented a bloody smartphone. Right, because that was just the way it was. You slept in the heat, and it was, it was awful. But everybody did it.
Yeah, just how it is.
But it's just how it is.
I can't wait to get smashed on TikTok on this section.
Bring them on,
Steve.
Bring them on.
Anyway, I'm going to move on swiftly before we've got pitchforks out the side, out the front. Mean reversion, something we talk about a fair bit, but specifically Wednesday on this week's week that was talking about China. Chinese stocks, they're trying to put in a base. It's one of the lowest it's been in the last 25 years.
Yeah.
No, 50, I want to say 15 years. And this is a brilliant example to start to talk about what mean reversion is.
Yeah. Well, it's just there's two things going on. First of all, when you buy something cheap, it's awful, right? No one ever says everything's fantastic and it's on a PE of 5, right? It's always ugly when it's on a PE of 5 or 10, right? Now, so that's the first thing. The second thing is the stock market is not the economy. Okay? The Chinese economy has improved about 500% over the last 30 years. Now, if the stock market was the economy, the stock market would be up a hell of a lot. The stock market is actually down.
Well, it's basically where it was in 2000
Yeah.
Exactly.
right now.
That's exactly right.
Oh, no.
Okay, so there's your...
Got to go buy.
So your first argument is don't bloody buy and hold.
Yeah. That's so true, actually.
But
this is an example. Why aren't we using this example when we're using example? China's gone nowhere for 25
mate, there's 100
years.
to choose from.
Yeah, that's true.
There's 100 to choose from. But that's what I'm saying. Now it's cheap. Now what I'm saying is I hold the China ETF because it's cheap. If you say to me, yeah, but Steve, I want a 100% certain story why I should buy it, well, I can't give it to you. But all I can say to you is, listen, every time you buy these cheap countries, they recover. Right? It's had 3 down years in a row. Property's falling. Chinese government's, mad. The world's deglobalising, blah, blah, blah. Yeah, but it's cheap. Right? And there was I think I wrote this in the newsletter or the week that was. There's an old investor called Walter Slosh in
What a name.
the US. And he said he just used to buy cheap companies. And he said, we buy them cheap and we wait for something lucky to happen. That's it. That's all it is.
Keep buying the cheap ones. Well, it's the law of averages, right? And it's like playing poker. You get given a good hand, and you go, okay, I'll double up this one.
Absolutely.
Well, even if it goes from 22, whatever it is, to 30, and that's not even reverting to the mean.
That's 30 to 40%.
Yeah.
That's what I mean. You can't see it now because it looks ugly, but I don't want my money now. I'm actually investing it now for the future.
Yep.
And again, it doesn't work every time. But if you say, all right, I've got $10,000, I'll put 5 in the China ETF, not advice, and I'll put 5 in cash. And if it goes down for a 4th year in a row, I'll put a little bit more in.
Yep.
Right? That's the part of the secret, which are the asset allocation and rebalancing. So that's why you buy the cheap ones. Because if you buy NVIDIA or the really expensive ones, yes, you may do well, but that's a big if. I'm much more comfortable saying I'm going to buy down here and go for the mean reversion because I know that's a principle.
Well, particularly when, look, Buffett says that you wait for the fat pitch.
Yeah.
It's down 3. If you just look at it from a purely unemotional perspective, it's down 3 years in a row. The chance of it going down 4, when you look at the bigger picture, is not as likely as it going up for a year.
And the Chinese government is saying, we'll have a look at stimulus, and because they don't now, the stock market is small in China compared to the economy, but it's still an important part where people have got their money. And if people lose money, they don't say to themselves, geez, I tell you what, I was a real fool buying that property. What do? They say, bloody Xi Jinping, I've been ripped off by a real estate company or blah, blah, blah. They never say to themselves, I'm an idiot because I didn't know what I was doing.
Yeah.
Right?
It's interesting. I'm looking at the novel investor here on China. So what are we looking at? 2018, you got down 18%, then up 23, then up 29, then down 21, down 21, down 11.
Yep, which means you've lost money.
Yeah. But if you invested after the 3 years that we've just had, or like what we are doing now, that if it goes up another 20 or 30%, then we're in the green.
Yeah.
So.
And that's generally what happens because a lot of you think at some point everybody goes, oh my God, this is so cheap, I've got to buy it. Right? That's generally what goes on. Because the risk and return, what you were talking about earlier, Jacob, you get to the point where you go, well, I might have a little bit of money on it. Gee, that's what it is. If you do that 100 times, you'll probably get 80 right. Even if you get 70 right and 30 wrong, you've made more money, right?
It's too easy.
It is, but trying to coach people is really hard.
Look, next topic that we got to talk about, it's just a chart.
Chart
you shared.
It's a chart. What's that,
It's
Tom?
a chart you shared.
What's a chart?
Ships ahoy.
No, I just had a question, right? So this highlights the companies that have benefited from all the wars that are going on at the moment, and it highlights the period from the start of January to now.
Yep.
At the top of the list is Ryan Metal at 367%.
Oh, you said that well. I couldn't say that.
Is that a German
I
word?
was trying to figure it out.
Did I say it right?
I don't know. I was going to give you
I
10
assume
bucks.
I said it right.
Sounds good.
Anyway, number 4 is Rolls-Royce. Can you just explain that to me?
Yeah, they've been, since World War I, I can't really explain it, but I know since the World Wars they've been pumping out.
Are they selling Phantoms to the...
Engines.
Engines.
Rolls-Royce do military engines.
Yeah.
Like Boeing, Lockheed Martin, all of those.
Yeah, like the planes, the old 1940s World War I, World War II airplanes,
Yep.
they built the engines for it.
Yeah.
Like 48 litre just beasts.
That's why you don't get China to build everything. Because in a war, you go, we need some planes. Oh, actually, we gave away all the planes to China. It's like, oops. That's what's happening right now.
Yeah, okay.
And America's going, Jesus, you guys, we according to these bloody legendary economists, everything went to China. Now we're not friends. And China's got a lockhold on 80% of the port cranes. Right? So the Americans go, hang on. They found out, this is 10 years ago, they found out that the Chinese were tapping in to the wind turbines. Right? Because the Chinese were supplying the boxes for for the wind turbines, and they're tapping in all the information. Australia found it with a company called Codan, right? We do mining sweepers and stuff, right? And the Chinese are stealing, Codan gets parts from China. Well, guess what the Chinese are doing? They're pinching it all. But it's only what the Americans did to the British, right? That's what all up-and-coming powers do. We all steal off each other. It's just a question of whether you get caught or not. And then you go, oh, that's terrible. Anyway, you do it to us, we do it to you, spade to spade. That's what they do.
I'm actually surprised Boeing aren't making more. They're right at the bottom there.
No, because if you read the history of Boeing, you read why it's such a shit company because it outsourced everything.
Oh, didn't know.
Boeing is basically hardly makes anything these days. The creme de la creme in aircrafts are the wings, and the wings are made in Japan because the Japanese zoomed in and was really clever and said, where's the really important stuff?
You can't fly without any wings, mate.
Right?
And the biggest engine in the world, but you can't fly without a wing.
Yeah, but
It's not a plane without a wing.
It's the really
big
technical
train.
stuff.
Rocket.
It's the really technical stuff, right? And that's where you advance, like the semiconductors, all of that sort of stuff, right? And that's, again, what you asked, I think, about last week, Tom, was, well, what's this mean? What it means is you look at these companies and go, oh, okay, these guys might be on a pretty good runway. If the government says it's going to build another, as you mentioned, Jacob, military expenditure's gone through the roof. Well, that means someone's making some money. Mm-hmm. As an investor, you want to say, okay, who's making the money, right? And go and look for them. That's the important part, right? That's why we're sort of talking about the new normal to say, if you're, Jacob, in COVID, right, you might say, okay, well, that's going to mean what? Well, it's going to mean a revolution in healthcare somewhere. Okay, well, who are the companies there, right? And you go through and look at that as an investor and say, this has got a really good growth runway, right? Okay, and the government are going to give it, $1 billion a year to make masks or something like that, right? That's where you look at it.
It's fascinating. Yeah. Or go out and buy a Rolls Royce. I reckon.
Aston Martin.
That'd be nice. I think next on something that we like talking about. What are we? We've got a few minutes left.
Yeah, keep going.
Commercial property price index, and the point we want to make here is, it might look all groovy over the last 40 years. Property prices has gone up, but there are periods in time where you lose 20%, you lose 30%, or the market doesn't. Overall, it goes up, but when you look at it and you look at your profits at the end of this 20-year stretch, and you extrapolate out the earnings yield,
the return,
sorry,
yeah,
you end up at about 4 or 5%. So this chart's fascinating. If we want to delve into this for a couple of minutes, fellas.
Yeah, I mean, if you ballpark the dates, right, you can see commercial property dropped about 20% from 90 to 95. It then goes up 185% over the next 13 years.
Yep.
Then it drops 37% in 2.5 years, and then it's gone up now.
GFC, hey?
4, yeah. And now it's just gone up 130% for the last 12 years.
And now it's in trouble again.
Yeah, well, it's gone nowhere for a bit. Yeah,
because the rates have gone up. Right?
Rates have gone up. Remote workers. Yeah.
Right. So, sorry, but it looks like a shit show because you look at it and go, well, hang on, I was borrowed at 1, now I'm borrowing at 6. I've got to, go and refinance. And, I had 1,000 officers and now they're 400. I've only got 400 staff there because everyone's working from home.
Well, the point that I've made, that it looks amazing when you look at it over the long term, but then you look at the compound rate of 3.8% and you take inflation off that. You end up...
It's pretty average, isn't it?
But then also, right, when you factor in the 4 Cs and COVID and how that kind of shaped the way we work now, it's all...
Exactly.
Telling a story.
That's exactly right. And just as a little aside, Buffett released his newsletter, and in there's a point there where he said, talking about earnings, and he said, when we look at, he didn't say this exactly. What he said was, we don't count unrealised capital gains. Right? So you think about
That's
that.
interesting, actually.
Yeah, you know why? Because what he's saying is, I want to know what the company's earning because I'm going to be holding it for his favourite holding period forever. That's the way you value companies with a discounted cash flow, right? You have a terminal rate at the end, right, which is generally inflation, which means it's not going to grow, right? But what Buffett is saying is, I want a yield ignoring the capital gain. Now apply that to a Sydney property. Right? You don't get a yield.
You're going backwards.
You're going backwards.
So
right?
he's treating it as like the capital gain's just a bonus.
Yeah.
But that is exactly what Buffett said. Buffett said,
Wow.
look, we do consider it, but we don't look at it and say, oh, this thing's losing money, but that's all right. We'll be able to get a capital gain out of it.
Yeah, but we mentioned this on a podcast way back, but Buffett's long-term forever holding period went from 20 years to, and I think it's at like 3 years now, Berkshire Hathaway.
In terms of what?
How long he holds an investment for?
No, he rebalances
Well, that's
all
what
the time.
I mean. So like he rebalances, but he's out there going, well, yeah, we're in it for the next 30 or 40 years, but in reality, he's rebalancing.
Absolutely.
So he's still
Absolutely.
skimming the profits and
skimming
buying in when it's dropping.
That's right. Yeah.
That's what we were talking about earlier in the coffee shop with Well One.
Well, it's the
right?
permanent portfolio stuff too.
Exactly.
In Well
Exactly.
3, so
Exactly.
Right, last one, chart of the week, because we're not missing it this time.
Right.
We'll talk about it for 2 minutes and then we'll close it off for people. But CAPE is at 34.5 at the minute. It's got strong government spending, and this is the US we're talking about. And I mean, that's showing that we're going to get, 3% return over the next 10 years?
On average, yeah.
what's
So
the forecast based on where it's at?
Yeah, exactly.
Yeah.
That could change.
It could be 2.
Yeah.
It could be
But-
1.
well, yes,
If it drops, it could change.
yes, that's right, Tom. So if you bought in the stock market now, you could expect around 3%.
Yeah.
If the stock market collapses from 5,100 to 2,000 and the CAPE goes from 34 to 13, then you're expecting 9 or 10% compound.
Or if the earnings somehow double overnight.
Well, yes, it could do, I suppose. That's a valid point,
That is
Tom.
a
There's a
valid
P and there's an E.
That's right.
Right. So if the price if the price goes nowhere and the earnings, the E doubles, there you go. It's absolute bargain.
Rocket science.
Yeah.
Jump in.
Oh, man. And there's a shart by the sounds of it as well.
Hey,
Right, we'll close
There's
it
a
off
bull
there.
market somewhere.
Look, the CAPE, we like talking about the CAPE, and I know for a fact that people are asking about how do they incorporate that into their investing now. So, as always, reach out if you have any questions about that, or if you want to know more about the 8 principles. But for now, we'll see you next week. Bit of a long one, so if you're still there, well done. Talk soon.
Cheers,
thank
folks.
you.
Stay up to date on our socials. Just search for Total Money Management on Instagram and TikTok. For your free investor personality assessment, go to totalmoneymanagement.com.au. And as always, remember, we don't provide financial advice.